Okay, so if I had to take a guess what two stocks I believe were most talked about on YouTube this past year, it would probably be Tesla and Tattooed Chef. But the question really comes down to, does Tattooed Chef deserve the amount of attention that it got? I mean, you have people like Jeremy from Financial Education saying that this company is so undervalued that it is his #1 position. But then you have so many other people that don't want a piece of this company or were in this company and then sold out. So in this video, I'm going to break down Tattooed Chef's valuation and fundamentals, as well as share whether or not I think that Tattooed Chef is a buy right now. Alright, so first let's go ahead and look at the balance sheet. The company has 9 figures of cash, which for a company that is valued currently somewhere around $1 billion, that's pretty good. They also have total current assets of about $207 million, whereas their total current liabilities is about $38 million. You don't see too many companies, even right now, to have that kind of a ratio. When it comes to their quarterly revenue, they had about $59 million, which is an increase of 43.5% year over year. But I believe for anyone investing in this company, what truly matters for them is their Tattooed Chef branded products, which came to about 56%. So when looking at these numbers, it appears that this company is looking really good. But now we also have to talk about some of the bad news. First, they missed on revenues these past couple of quarters by about 7%, and they also missed EPS the last 3 quarters. Another piece of the bad news is the reduction in their margin. The reasons for this is the increase in raw materials, packaging, and freight and container costs due to inflation. The last piece of bad news that I wanted to share is the reduction in their guidance. They are now expected in the year of 2021 to have somewhere between $210 and $215 million. But from the previous quarter, the company was expected to have $235 to $242 million in revenue. And that is a decrease of 10% in their guided revenue. Now, if I were considering investing in this company, there is a major piece of all of this that I need to pay attention to. With a lower guidance, the company would expect to have revenues between $48 and $53 million. That would mean that the company would grow revenues 20 to 30% year over year. And quite honestly, that's a lot lower than what many people expect this company to do in the future. But I believe that the company realized that they were overestimating. And so they might be underestimating on purpose so that they can have a good beat this upcoming quarter. But what I find kind of interesting is the reason for their lower projected revenue. The chief financial officer, Stephanie Dykman, said, "With the holidays last year being more stay at home and not normal, it's really hard for us to predict the consumer behavior that's going to happen in the healthy eating space. And so we looked at everything, and this is where we feel very comfortable guiding for this year." So someone can look at this, and with the uncertainty of the management team, this could be frightening. But the fact that the company admits that this is a comfortable guidance goes to show that honestly they could blow these numbers out of the water. But I will say that even though there's a low guidance, it doesn't give a good reason why the revenues were significantly lower than what many analysts expected. Now, of course, they don't have to give a reason, but if the revenue growth is significantly lower than what a lot of people expected and they increase their store count dramatically, how does that add up? This question, along with the company lowering their revenue guidance, should be something to ask and answer before investing in this company, in my opinion. Now, with that said, let's go back to some good news because I think that this company is still intriguing at these current share prices. When we look at the new categories that they are adding to their potential market share, they are increasing at a decent rate, and salty snacks are a huge opportunity for them. Now, I don't think that we're going to see the effects of these salty snacks until the second quarter of this year. But when we do, I think that there will be a significant amount of revenue from this category. If we look at the TAM, or the total addressable market, Tattooed Chef is going to improve from $44 billion to almost $162 billion by 2030. With the multiple verticals, this creates great opportunity for the company to take market share. Another good thing about this company is the acquisitions that they've made, not only to increase revenue, but also increase overall production capacity in the US. This will hopefully help them reduce expenses. The final good thing that I want to share about this company, they are now basically in any grocery store that you can think of. And this means that they could get a lot of attention this year, leading to some high growth. Now, unfortunately, over this past quarter, we did not see great results. But I do believe that a lot of these stores started displaying their Tattooed Chef products in the 4th quarter of last year. So if we don't see good revenues this 4th quarter, then my decision to buy this company will already be made. I do believe that this is an extremely important quarter for Tattooed Chef because it's going to solidify what their growth is going to look like year over year. I think this past year was really difficult for analysts to come up with accurate estimates because of the new public company and the new sector. But right now at current prices, do I think that it is a buy? Honestly, I think I see better opportunity elsewhere, especially when you see all the uncertainty when it comes to supply chain issues and inflation. One thought that comes to my mind is the company talking about the freight and shipping container costs increasing. If the demand is still high and the company still needs to use these products even though they're increasing production capacity, what is stopping these freight and shipping container companies from keeping their prices high? Personally, I don't think it's a good idea until at least Q4 numbers come out. And I'm not gonna make a move until I see improvements in their revenue growth rate and margins. There's simply just not enough clarity when it comes to what this quarter is gonna look like. And even though we've seen tremendous growth in these stores, we haven't seen if the number of stores truly correlates to the amount of revenue that they could have this quarter. So what I'm planning on doing is waiting until after the second quarter of 2022 results have been released. That way I can get a good idea to see where the company is at and how they've improved. But personally, I see great opportunities in growth companies that could be profitable this year. And so I'm going to be focusing on those before I make a move. If I see strong growth and their margins improve to where they can show me that they could be profitable in 2023 and they're under $15, then I'll consider adding this one to my portfolio. But I hope you guys enjoyed this video. If you don't mind, would you consider destroying that like button? Helps this channel immensely, as well as comment down below your thoughts on Tattooed Chef's valuation. Would love to hear your thoughts on that. And if you are new here, hit that subscribe button down below. That way you are notified when new content comes out. Hope you guys enjoyed the rest of your week, and we'll see you in the next one.